Hello, this is Edmund Shing of BCS Asset Management. In our global strategy today, we will be looking at the comparison between global stocks and bonds. We're going to use the stock-bond ratio. What is this? Well, this simply compares the total return over time of a stock market index, for instance the S&P 500 index. We compare this against the total return of a bond index, such as the Barclays US Aggregate Treasury Index. This gives us, when we look at stocks divided by bonds, we then get a good long-term measure of relative value between stocks and bonds. This is the global stock-bond ratio, and you can see that it is basically from 1987 to now, it's not really moved very far in either direction. What I mean is stocks haven't really gained a lot versus bonds since 1987, although right now they are slightly above the long-term average. And this you can see really right now in 2014, we have seen strong performance from the US stock market despite the heavy buying of US treasuries by the Fed. Now, if we look at this for the US market in particular, we can see that the ratio today of stocks versus bonds is very extended. The stock market rally has been very sharp, and despite the buying of bonds by the Fed, we have seen, in fact, stock markets perform even better, to the point where stocks look relatively expensive versus bonds in the US. Even if we look at US stocks against corporate bonds, you have a similar story. So here we can see that against investment grade bonds, the line in blue, they still look expensive. However, when you look against high yield bonds, the dotted line in green, stocks look better value. But they look expensive in the US against both treasuries and against investment grade corporate bonds. They only look relatively decent value against high yield bonds. In emerging markets, we have a different situation. We have stocks which are in line with the long-term average against bonds, neither expensive, neither particularly cheap. And here you can see it's been fairly in-line performance over the last couple of years. If we look, however, at emerging Asia, so focusing on Asia in particular, we can see here that the stock-bond ratio is below its 12-year trend. So this suggests that there could be more potential for stocks versus bonds, at least in Asian countries, going forwards. But the real value is to be seen in Europe. Here we have the euro stock versus bond ratio, which again looks pretty low. Remember that in Europe, stocks yield 3.5% dividend yield, which is far greater than the bond yields from government treasury, from government bonds right now. And you can see this trend has been very largely in favor of stocks since late 2011, but is still low versus the long-term average. The other area where we see value is in Japan, where stocks have underperformed really for most of the last 20 years. So the recent rally that we've seen this year and last year is still very small in comparison with the downtrend, the relative underperformance of stocks, which suggests that stocks still have quite a potential way to go to correct this undervaluation. So, in summary, US stocks look rather expensive versus US government bonds. They only look maybe reasonable value against high yield corporate bonds. If we look at emerging markets, Asia looks like it could be relatively decent value. But the real value looking at the stock to bond ratio is in Europe and in Japan. This is Edmund Shing saying thank you for watching.